Hello all and welcome to today's webinar. I'm having a few camera issues that my camera is not wanting to connect up. So I'm going to run without it so we can go on, we can get underway. My name's James Gerrish and welcome to today's Market Matters webinar. We've titled it Pulse Check Gold Fever. So we're going to dig into the gold sector. I've got Sean Hickman on the line who's going to join us. I'm, of course, the lead portfolio manager at Market Matters, and Sean is our research lead. So we're going to dig you into some ideas around the gold trade, our views around what the sector has in store ahead. It's obviously been a phenomenal run in terms of gold, physical gold, as well as gold equity. So we'll dig into some of that, and I'm sure we'll get onto a couple of other things that are catching our attention in the market at the moment. Just as a quick guide before I begin, I've had 20 plus years experience in the market, managing a fair amount of money and writing about our experiences on a daily basis. Sean's had over 30 years experience in markets, so we're well and truly experienced. We're writing about what we're seeing on a daily basis in terms of our market calls and trying to articulate those things and the nuances in the market to our Market Matters members. Quick disclaimer before we get into it. Just a reminder that any advice today is of a general nature only. It doesn't take into consideration any one person's circumstances. So general advice only. Quick overview. We start our webinars with our quick overview of our investment process. We call it a top-down meets bottom-up investment process. We look at the bigger picture macroeconomic drivers. We dig into sectors and where we want to be from a market's point of view, then stock selection and portfolio construction. So I'll leave it there. And just to give you a rundown of today's webinar, we'll look at gold, ask the question, is it as good as it gets for gold? It's obviously been a phenomenal run. We've written that a few times recently. Stocks, how we're playing the gold theme, whether or not we're going to continue to back the gold theme, and probably around the broader resource space, because I think that's probably an interesting topic of discussion around whether or not the China trade has fizzled. We obviously had a big bump up in share prices from a lot of the resources companies in Australia, but then they've somewhat fizzled out in the last couple of weeks. So we'll dig into that, and then some Q&A where we'll get there. I'm going to share my screen. And you should be seeing the Market Matters homepage, and I'm just going to bring in Sean Hickman to say hi. You're on mute, Sean, so yeah, jump on.
Afternoon, everyone.
Interesting time in market, Sean.
It's fascinating. Whether you like to watch the presidential circus just for a bit of backdrop, or the fact that we're at all-time highs moving towards a potential Christmas rally. And as we're sitting at the moment with gold at all-time highs, there's a lot going on. It's really, really interesting times, but it's our bread and butter, James. We like it, whatever's happening within reason.
We do, mate. Markets are a very interesting place to be. So I'm just going to get gold price in AUD up as the first thing to talk about, Sean. Just to give some background around sort of how Sean and I guess, break up our focus in the market around what Market Matters writes and publishes. Sean's very much top-down macro specialist, is very much around looking at these sorts of trends. So the bigger trends in markets, I spend a lot more time analysing companies, doing the fundamental backdrop of why we like what we like. So gold prices in Aussie dollar terms, Sean, quarterly chart, very long-term chart, but it gives you a sense of where they've gone and where they're at now.
Exactly. We don't normally use quarterly charts, as subscribers would know, but at the end of the day, sometimes it is good to stand back and get a feel of what really is unfolding. And at the moment, we are in a huge bull market for gold, far more so than equities, even though they've been knocking on all-time highs in recent weeks. So in Australian dollar terms, especially because the Aussie's been pretty weak, it looks fantastic, and it should be phenomenal news for Australian gold miners. Not always the case, but it looks fantastic. And there's quite a few reasons behind that, James, but it all comes down to demand. You know, gold isn't inert metal. We know how much production can come on board, give or take, but the demand side of the equation is where the real variables are. and the demand side is incredibly strong. I'm not sure what chart you're going to pop up there, but I'll keep
Neither
talking,
am I,
James.
Sean. I haven't really prepared for this, so you've caught me on the hop around this. So this is around ETF exposure and gold ETF holdings.
So in Q3 of this year, the increase in gold demand was by 5%, according to the World Gold Council. That's 1,313 tons of gold more demand. That's 100 billion US dollars. In other words, the demand is enormous. And it's an interesting, everyone says, oh, the demand's there because of the world uncertainty, because of Trump, because of interest rates, et cetera, but I'd break those down and I'd argue about a few of those points. I mean, for example, gold has been going up all year. If the Middle East was driving uncertainty, crude oil would be a lot higher than it is today. Trump is already a 66% favorite to win the election. I think it's closer to a coin toss personally. But at the end of the day, that's not driving gold, because gold's been going up all year, whether Trump's ahead or behind in the polls, even when Biden was there. And sure, we are seeing interest rates coming off in the US. So that is helping. There's no doubt that's helping. But it's not demand. It's not driving that underlying demand.
I've got a chart just putting on the screen there, the US dollar index. So obviously one of the big drivers for gold, they're priced in US dollars. So the denominator is the greenback. In the last couple of weeks, we've seen a really strong rally in the greenback, putting pressure on the Aussie. Why has gold just completely ignored the rise in the US dollar, Sean?
Well, my opinion, because obviously one would never know, is the baton of demand has been handed over. So the huge demand that's come through over the last year, huge amount of it's come out of emerging markets. Obviously, China has been a driver, India, but in China, you've had the situation where the average Chinese person on the street are not big followers of equities. They believe in property and gold. And we all know what's happened to the Chinese property market. It's had a horrible year, horrible few years, actually. So gold for them has been a great hedge against the property market, has been a great hedge, even investment, against their depreciating currency. So there's been a huge demand out of China pushing up gold, and they're not looking at the US dollar, give or take a day. It doesn't bother them. And that's only a few weeks we've had that kick up, James, as you say. And that's as people have backed off on their bets for rate cuts moving forward. And then what we're now seeing is the baton of demand is being actually handed over to the Western economies from China and emerging markets. So the demand is still there. It's still very, very strong. I think gold keeps on going without having a rest. It's a dangerous place to buy it here now. You've got to be prepared for another $200 pullback. And I would say you need some ammunition in the kick to accumulate into that pullback. But the trend is up. It looks great. But I do feel it's looking a little bit tired if someone was to put me on the spot.
If I play devil's advocate and think about what you just said around gold and being, there's no other alternatives for Chinese investors, etc. Property's been a really tough place to invest. Then you think about obviously stimulus coming out in Beijing. They're doing a lot to underpin domestic consumption, turn around the property space. If that works, what's your outlook on gold? I would have thought that gold would have lost some of its shine, if you like. I hate that cliche, but some of its shine in that sort of environment. So, we're big at, I guess not. I was going to say fading trends, but we're not scared to sell into really strong markets or buy into weak markets if we believe that there's, I guess the canoe is imbalanced over one side, because that's where you get, we were a little bit concerned that everyone was bullish gold, and this was a couple of $100 ago, we've got to say, and we trimmed, some of our gold exposure back then. We've still kept some. But it concerns me that everyone's bullish gold, and if there are some things that may make the outlook less bullish coming, in the near future, then now's could be as good as it gets for gold.
Well, I think I wrote about that in recent weeks about the fact that we have got that concern if Chinese property starts to turn, they might take a bit off the table with their gold trade. Hey, they're sitting on a lot of profit, especially in terms that it's priced in US dollars, and they might go back into their property market. That's a heck of a big sentiment play, but once it goes, it will go. But as I just mentioned, the buying at the moment, the buying demand, which was very, very strong last quarter, and actually surprised me how strong it was, that buying demand has actually passed over to the Western economies. So it's gone from EM, it's gone from China, predominantly this is, to Western economies. And I think the other factor to bear in mind is central banks, James, are still buying. Central banks are huge buyers. And while they're still buying gold, and they're probably looking at debts and global debts and et cetera, the bigger picture, the support's there. So if you were to say to me where is the next $200 in gold, I would say I think it might be up 100, down 100. I could see us we're really, really overdue a rest.
Sounds like you're sitting on the fence there, Sean, to me.
Well, that's why we've taken a little bit off the table. I'll put it another way, James, because I don't like to sit on the fence. I think gold is a fantastic buy into dips, but I wouldn't fire the whole cannon here.
Okay, so we're not buyers of gold here. Where we would increase gold exposure into dips, but what are we in terms of our gold exposure? So if you just jump into I'll try and use the website as we move around today's webinar as I normally do. This is our active growth portfolio for those new to Market Matters, and we look through. We show all our holdings. It gives you 20-minute delayed price changes. We're having a tough day on AGL Energy today. If I dip into Evolution, we've owned it since $2.94. It's obviously up a long way. We have trimmed it, so we had a bigger weighting in Evolution, and we trimmed it. So what would you be doing with, what's your view on Evolution here, Sean? I've got some views from a company-specific point of view, but what's your bigger picture? How does the macro feed into our Evolution holding?
Evolution is 25% copper, 75% gold, ballpark figure. I believe strongly that we've again mentioned this a few times over the previous months. I think Evolution is a fantastic company. I think they're doing everything right. Their recent quarterly was very, very positive, and we can see that being reflected in the share price. I believe that much as I've said that gold might consolidate around here, sitting on the fence as you accuse me of, the trend is up. The surprises will happen with the trend, and I believe that a 3% position in Evolution is a must in this active growth portfolio.
I agree. So our view is to hold Evolution. We'd probably top it up again into dips below $5. We've got no intention of selling our Evolution holding. Just to give you a bit of background on Evolution. So when you think about gold miners, we like to stay primarily with gold miners producing in Australia. Evolution does they've got full-year guidance in the market this year for 710 to 780 ounces of gold. They're probably going to do something around 760. They did about 190,000 ounces for the quarter that Sean just spoke about. They've got an all-in sustaining cost base of $1,669 Aussie. And when you think about gold prices trading above 4,200 in Aussie dollar terms, and there's a big margin in there. So Evolution should do something like 650 million in profit this year. It hasn't always been this plain sailing. So Evolution had a history of really struggling operationally and not delivering. So whenever you had a quarterly coming up for Evolution, we used to be really concerned about what they were going to deliver. They've really got that back on track, and they've been consistently focusing on delivering to expectations. That wasn't always their fault. They've got some challenging assets, but it seems to me like they've got a handle on their challenging assets. Speaking of challenging assets, Sean, Newmont is the other big one that everyone likes to speak of. So what's your take on Newmont? They obviously had some issues last week.
Big cost issues, as you know, James. The stock has fallen 20% after those cost issues. And I've had a good look at it this morning because this is still a bit of a cash cow. It increased its buyback by $2 billion to $3 billion. So that should support it. But it's got some real operational issues, cost issues, and it's kind of a bit like Evolution used to be. This is the largest gold producer in the world. It's recently bought Newcrest Mining. So quite a few people listening to this webinar might own Newmont as because of their old holding in Newcrest. It's I put it in the wait and see basket, James. We've seen the trend of this year is the strong getting stronger, the weak getting weaker. And unfortunately, Newmont is in that weak bracket. It's not delivering. And the fourth quarter, it's interesting. The fourth quarter guidance is for all-in sustaining cost of $1,475. Their estimate for the last quarter was $1,445, and they came in at $1,611. So they missed by 13%. It's a huge miss. And I think the market's already saying, we don't believe you next time.
No, well, I don't believe them either. So they've got the issue that the rising costs are playing out because production is going to be lower. So very recently they put out a big 5-year plan around production. So they do about 6 million ounces, that give or take a year. So when you think about Evolution does about 750,000 ounces this year, Newmont is doing about 6 million ounces. Their guidance is actually 5.6 for calendar year 25, but it ratchets it up a little bit from then on. What it seems to me, and this was on the conference call after they produced these numbers, which showed a big uplift in costs, there was a lot of stress on production profile moving forward and what drove the increased costs. And only recently, with their 5-year production, I guess, roadmap that they put out, it seems like they just stepped completely back from that. So it seems to me that production is going to be somewhere between 9 and 10% lower than the run rate they put out just recently. So the market's completely lost confidence. I could see there was a lot of frustration from analysts on that call. And to me, I think it's lost the market's confidence. One of the interesting things, if you rewind that, long-term investors will understand Lihir Gold. So Lihir Gold, really challenging asset they've always had on Lihir Island. That was bought by Newcrest, and then Newmont has acquired Newcrest. And that is how they've come to get this Lihir. That's a really challenging asset. There's always had consistent issues with that asset, and that came to bite Newmont again. So to me, you want to own the gold stocks that have been executing. We've fallen a little bit into that trap historically. So Northern Star has been that gold company that has always consistently produced, and it's outperformed as a consequence of that. Evolution is the gold miner that has just started to consistently execute operationally. It's still cheaper than Northern Star on most metrics. So that's well and truly our preferred gold company. Sean?
No, exactly. And I think at the moment, it's probably been held back slightly by the 25% copper, but we feel that will be a tailwind over the coming years. So yeah, totally agree. I think Evolution's our local pick. There was one other stock I wanted to just look at just very quickly. I know you said, am I sure? But can we have a very quick look at West African Resources? Because I want to make a point here. So this is because James made a point earlier, as we like reliable, ideally domestic companies. West African Resources is one of the best gold producers performance-wise all year, but it dropped 20% a few weeks ago because the country, it's actually used to be, when I was growing up, its mine was in a country called Upper Volta. It's now called Burkina Faso.
Burkina Faso, yep.
Yep, okay, I was going to ask you how to pronounce it, so thank you for that. I wasn't quite sure. Yeah, this is a fascinating business. It's got a $2.2 billion market cap. On its latest results, which are absolutely strong, it's got $430 million in cash and $43 million of unsold gold. So everything looks really, really solid. But the government recently came forward and said they were contemplating pulling in some of the mining permits, and we saw a 20% drop in West African gold. And that adds a dimension to the volatility, which puts it outside of where I'm comfortable for the Market Matters growth portfolio.
Yeah, me too. So I mean, it's been a phenomenal performer. I just think I think keep it, the KISS principle. We often write about that. Keep it simple, stupid. We don't need to go into that area of the market. I know it's been the best performer, but it's probably when we look at an investment, we look at through the lens of risk reward. Always look at things through the lens of risk reward. And WAF for us has got too high a risk for our domestically focused growth portfolio, particularly when we've got a domestic operative in Evolution that is executing. Just to give you an idea, that cash balance, Sean, that will be in West African resources. They've got some development, so they're only at about 200,000 ounces a year. At the moment, they've got development that they're going to build out some additional mines, and that's what's going to, the funds will be earmarked for that. The other one that we've got, of course, is Barrick Gold. So we own Barrick Gold in our that's the gold physical. So Barrick Gold in our international equities portfolio. I'll just get you some details up on Barrick. You can search for the company through there, or you can do the code. The code didn't come up because I didn't put the US on there. But Barrick Gold hasn't really been, it's another big producer over in the US. It hasn't really been performing as well as the likes of Evolution.
No, and although it's had a heck of a good time compared to Newmont, so everything's relative, James. I think this is a case of steady as she goes. There have been better places to be, without a doubt, as you said. It's not really doing anything wrong. It's just not, and it's not, most definitely not in the same camp as Newmont. It's steady. It's rallied. It's had a fairly good year. I wouldn't be chasing it here, but I'm happy to hold it here. It's got the right exposure. Everything looks good. All-in sustaining costs are below 1,500. As long as gold stays up here, that looks great. These are cash cows, as you know.
So the other things to consider in terms of gold is you can buy physical gold, you can buy gold equities, you can buy gold ETFs. I just had the chart of a gold ETF on the screen there. We do have in our core ETF portfolio, which is this is the Market Matters most recent portfolio. We launched it in July of 2023, so the performance data is only early on in the piece. It's a diversified exposure, roughly 60% growth, 40% defensive assets. It has a gold exposure. So this is the physical gold that we have in that portfolio. From a portfolio construction sense, we've got a 5% weighting in there, and that's been stable since the inception of this portfolio. So it's a really good place to go if you're looking for ideas around asset allocation and what a portfolio, how a blended portfolio is structured. There's the physical gold ETF that you can see on the screen there. It's been a phenomenal run, Sean.
It's had a great run without the headaches of Newmont or West African Resources for those couple of weeks. And it depends on, we feel as Market Matters, our strength is to identify the quality stocks like Evolution, but there are times when we get it wrong. Unfortunately, we are human. And if people just want a nice, reliable, when I say conservative, you've got to be right. Gold price has got to go up. Gold stocks have got to perform. But it is a more steady way of playing the gold thematic if you don't want to take the next step and go towards gold stocks.
You take out those operational risks in specific companies. But that's the thing with gold equities. What I'd say around that is if you get one that's executing operationally, then the leverage to the gold price will be well and truly above what a gold ETF is, given that the gold ETF will have the one that's executing operationally. It'll also have the one that's not executing operationally. So you go in there and buy Newmont. So everyone talks to banks being a really expensive area of the market. I constantly hear people talking about that, but you go and buy an ETF on the ASX 200, you're predominantly owning banks, which I think is probably another riskier thing, Sean. To me, the way to go out there and do this is if you're an equity investor, and we've got multiple equity portfolios. So we've got an active growth portfolio. We've got an active income portfolio, which is obviously focusing on income. We've got an emerging companies portfolio, which is a higher risk proposition. International equities, all of those portfolios are focusing on stocks or securities in the case of the income portfolio. And then we've got a core ETF portfolio for those who want to focus less on the individual stocks and more on the bigger picture themes. Sean, we were going to be really sharp on this webinar, and I've had a super busy morning so far, so I haven't prepared further on. But I've got. Should we move on to questions, or was there other things that you wanted to cover in the resources space quickly?
I think just very quickly on the gold front, let's put forward our summary. Yep. Evolution, local gold stock, stay with it. It's why we're long. We like it very much. Buy into dips rather than sell into strength is where we are at the moment. In terms of overseas, it's too early to buy Newmont.
Yeah, fair enough. So a little bit cautious at the moment. And I think the next thing we're talking about, Sean and I were talking about this morning, just messaging on Bloomberg around our views around Trump trade, etc. And I know Sean just highlighted, I touched on it first up, around uncertainty playing out across markets. So uncertainty around what's playing out in China, uncertainty what's playing out in terms of the US election. That's one of the reasons to go and buy gold. I know he cited that it's not a huge driver, that physical demand is the driver. But if you think in a couple of weeks' time, we're probably going to have a bit more certainty around those two factors. So we'll see the next salvo of stimulus coming out of China. Hopefully it's a big one. We're positioned for a big one. And we'll get some clarity around the US election and what the US political environment will look like moving forward. So you take those couple of variables out, and ultimately we could get some resolutions out of the Middle East as well, Sean. So you take those variables out, they're the things that will be playing positively into the gold price. I don't think they're playing negatively in the gold price at the moment. Then you could well see a decent pullback in gold.
No, absolutely. And I think that's what I said. I think you want to have some ammunition. And the most exciting thing at the moment in the market is on the stock and sector level. And all those factors you just mentioned are going to create a lot of the market. The index might not move, but a lot of stocks are going to move a long way.
So that's an interesting thing around the index. And there's questions coming through. And one of the, I've had about 3 questions this morning coming out about MinRes. So Mineral Resources, just for disclosure, we've got one of the things you'll get at Market Matters and subscribers understand over a long period of time is total transparency. So when we get it right, when we get it wrong, we're totally transparent in the way that we show that to our subscribers. One of the positions that we haven't got right is Mineral Resources. We put our hand up and claim that it's been a drag on our portfolio. Luckily enough, our performance in other areas have been really strong over a long period of time, but it's still been a drag on our portfolio. A couple of questions around this morning's announcement and whether or not we should be buying more of Min at the moment. Sean, I don't know whether you've got some comments here. I've got some comments around their balance sheet and what it means.
I think today's announcement. Sorry, James. I think today's announcement is very good, very strong. If we owned 3% the active growth in Min, sure, I'd put my hand up and say, James, I think we should buy some more. We haven't. We've got 5%, and we are still fund managers, active fund managers, and we have to look at prudent risk reward. You've used that phrase already today, and start putting in more than 5 or 6% into a stock that is still probably going to get further news on the Chris Ellison saga, to me is not prudent, but I am comfortable holding what we've got.
Yeah, so the stock's up about 14% today. So they came out this morning and they announced a deal that they were going to sell some of their gas tenements to Hancock Prospecting. Deal's worth about $1 billion. So probably the enthusiasm of the market's being tempered a little bit by this looming not decision, but looming information coming out or update on the Chris Ellison situation, which is due out on Monday. Just rewind the tape, and there's a question here on what does it mean for Min's balance sheet. So when they reported their results, full year results, they had net debt of about 4.4 billion. So the market got really concerned about that because they were also guiding to higher capex, so higher development spend going forward. Since then, they've got about $1.3 billion in the door for a 49% sale of their haul road. A haul road's about 150k haul road, so it's a big one. So that's a positive for the balance sheet. This morning, assuming they get the $1 billion in and it comes in this year, they're suddenly looking at a net debt at 4.4 billion, net debt closer to 2 billion. That's a huge change for Min, and that will alleviate some of the pressure on their balance sheet and concern from the market on their balance sheet. Shorts were super high in this, Sean. So I think last time we did a webinar, we talked about min, and shorts were sitting around 12% or 13%. They're down at about 10% of the share register at the moment. I suspect, we're getting some short covering today. There's no doubt about that. I suspect, depending on the update that comes on Monday, if it's satisfactory, I think it probably will be. I think the board's probably got this in hand. Then we'll see further short covering. If you've got, so 10% short on min, min's got about 200 million shares on issue. So that's 20 million shares to buy back. And you can see on the market today, it's done 2.7 million shares so far. So it's there's still a lot of shares that need to be bought back that are held short, looking for lower prices, and ultimately looking for min to implode. I don't think that's going to take place. I think the deal that they've done with Hancock today is a really good one. The deal they did to sell their 49% in the Hall Road was a good one. So that answers about 5 questions all in one hit, Sean.
Exactly. And going back to, if China do go hard next week, and there's even rumors, and there's a lot of rumors at the moment this time of year. There's always rumors, but there's rumors they might even go harder if Trump wins. But that's a bit of a probably pie in the sky. But if they go hard, it's good for iron ore. Obviously, the lithium side of the balance sheet is still not great yet for mineral resources, but I wouldn't personally want to be sitting short.
Yeah, but you look at no, me neither. So we're maintaining the rage on min, even though we've been wrong on it. Interesting announcement from Pilbara yesterday, just around lower production. As we've often said, there's the remedy for low prices is low prices themselves. You see this sort of thing come off. So you take off the higher cost production comes out of the market, no new production is incentivized to be built, and ultimately prices correct. We've got a lot of questions on Newmont here. So Chris asking, is the big pullback worth buying? Adnan is asking, Newmont costs have gone up, but nothing compared to the gold price going up. Also, they're forecasting their costs back in line. We've pretty much covered Newmont. The cost, just on the cost side. So I guess everything comes in markets, things move relative to market expectations. So the market has been guided to lower costs, higher production in a comprehensive outlook provided by the company. In the first quarterly that comes up that Newmont delivers is well down on that, and they seem to be rejigging the market's expectations lower. So the market doesn't cop that very well. So it's all relative. So if you can go and buy a relatively more attractive, less risky proposition, you go out there and do it, and you don't own the one that's struggling like Newmont. So we don't have any interest in buying it here, Sean, even though they're.
Have a look at it. There's nothing we like more than a good quality company getting oversold. But I really feel in this case, talk is cheap. Until they step up and start delivering, it's too hard, especially if gold looks like it might have a pullback. This will probably get hit even harder. Yeah.
So Robert's asking, how will Trump Harris? How will a Trump or Harris win influence the US dollar? You want to take that one? I've got my views.
No, I'll take that one. I mean, it's the market's factoring in a Trump victory. That factor is factoring in interest rates higher for longer, which by definition flows onto a stronger US dollar. So I'm looking now at my screen. The US dollar is trading at just above 104. It was trading at 1. That's the dollar index, I should say to everyone. So at the moment, the market is factoring in probably a Trump winning by 60 or 70% chance of him winning. So if Trump wins, the US dollar will strengthen. In my opinion, if he loses, it will weaken. And it's all about perception about how the spending is going to go to funnel in what he wants to do moving forward.
Yep, exactly. So Trump's policies are more inflationary than Kamala Harris policies. More inflation means more interest rates staying higher than they otherwise would. Higher US interest rates, bigger interest rate differential, therefore the currency goes higher. So we covered that one. We've got just around Iluka and Sandfire. So yeah, we trimmed Sandfire, Alan, yesterday. So to give you an idea, I'll get our active growth portfolio up. We've had Sandfire in the portfolio for quite a while. We bought it back in May of 23. We had a bigger position in it. All we've done is we've trimmed one position out of Sandfire around $10.30. We're up about 60% on the position. We also trimmed some money out of South 32, 1%, taking a profit there as well. All articulated on the Market Matters website. So when we make a change to our portfolios as a subscriber, you get a text message onto your phone telling you exactly what we're doing before we do it. And we also send an email and an alert on the site, which you would have seen an alert on the site here now, which is what we're doing. So it tells you exactly what we're doing, stays on there for 48 hours, our reasons why. And one of the buys yesterday was Iluka. So Sean, mineral sands / rare earths, been an absolute pig of a trade, I guess, in the last little while. It's challenging conditions for Iluka. We have owned this in the past. We've made money in the past. We've bought it yesterday.
Yeah, it's been good to us, actually, James. It's one of our best sales of the last year or two. This is a play on the China turnaround story. And because of that, it's one of the reasons why we trimmed Samphire and South 32. You know, again, you can't have all your eggs in one basket. We wanted a bit of diversification. If the Chinese property market, which is obviously very, very, under a lot of pressure, if it can start to stabilize and improve, you're going to see a big turn up in a big improvement in that pigment side of things, and also rare earths. I think it's time for that to start to improve as well.
Yeah, the news flow has been diabolical for Iluka. You can see on one of the things that you get is on the site, you see analysis, which is all about the position. Every time we write about that stock, it'll go onto this page, and then all our actions on this stock. So you can see back in May of 24, we sold it, we took profit on it. We consistently wrote that we're bearish Iluka. We then started to suggest that we're getting cautiously bullish around $6, cautiously bullish around $6. And then we've ultimately gone and pressed the button around $6. You can see that there, and that stays on the website. It is there for eternity for everyone to see what our past calls are on a particular stock and how that has transpired over time. So Iluka is not for the faint-hearted, right? So it's a higher risk proposition, but we think the news flow has been incredibly bearish. We think the chance that they will surprise on the upside is high because market expectations are so low. Should you hold LTM until BHP writes checks or go now? Cole?
I'd rather
hard one.
Yes, yeah, I'll let you go there, James.
Oh, thanks. So Colin, I haven't. I mean, this is going to famous last words, but this is going to go through. It's whether or not. So for me, when I hold stocks like this, it's all about what I can be doing with the money. So if I'm, this is just talking about me. If I'm short cash, then I'll take the money and move it elsewhere and recycle my capital that way. So it's more of an individual decision. I think the deal will go through and the funds will come back. And it's unlikely there's going to be a competing bid. I don't know if it's actually been confirmed yet, but yeah, that's more of a personal decision. We've got Gold Road Resources. Question on that. They're set to reach 350,000 ounces on their joint venture, 17% interest in DEG. What are your thoughts on Gold Road? So yeah, I mean, this is one that we've looked at not recently, but it's been a phenomenal performer as well. Not on the 12-month view, but it's starting to perform now. So I don't know if you've got a technical view on Gold Road. I actually haven't looked from a production standpoint in a little while.
I just think you've got to pick one of them or two of them, James. And it doesn't get ahead of evolution for us on any of the factors that matter. But it looks good. And if I was looking for a gold play and I had a preference for this over the other ones, I don't see a problem with it for gold exposure.
I'll take that on note, because I hate Tony. I hate coming back with sort of wishy-washy answers, because I haven't looked at the how it's tracking operationally in a little while. So we'll take that on notice and come back with an update on gold road resources in the not too distant future. We might leave it there, Sean. There's a few other bits and bobs around questions, lots of ASB. That's I'll leave that one. I think we'll end the webinar there. We'll be short and sharp today. Quick 45 minutes. You'll like that, Sean.
No, absolutely. I've got to go back, start looking at the questions for the weekend. But the most important thing, I think, hopefully we've got the message over on gold. The demand is still very strong. Central banks are buying. There is the question mark coming through if the China starts to get some significant inroads to improve their property market. They might not necessarily be sellers, but they might stop buying. The Western economies have started buying, so demand is strong from central banks at the moment, but it's run a long way. So our favorite stocks are there, Evolution in Australia, and for people overseas, we prefer Barrick over Newmont.
Yep, exactly right. Holding what we've got, not buying here, buying weakness if it prevails. And in my view is, I think there's probably a good chance that we'll get weakness in gold prices. I know the momentum's all strong, strong there, but I think there's a few little catalysts that could see better risk reward entry positions or levels into the gold trade. So I'll wrap it up there. Thank you all for joining us on this reasonable Thursday. I was actually just in a presentation before jumping on this with Charter Hall around an office fund they're launching. It was interesting as I'm looking out at a construction site here, which Charter Hall, we're in Chifley Tower, is building a new tower there, and some of the dynamics, and I think we'll write about this in the coming weeks. Some of their views around the office market was quite interesting. So we do lots of interesting stuff at Market Matters, and we write about it in our notes. So hope you enjoyed today's webinar. Sean, thanks for joining us. Have a great afternoon, everyone. We'll speak to you soon.
Thanks,
Bye for
guys.
now. Cheers.
Bye.